This is a great example of basic transaction analysis in accounting. Here's a breakdown of what's happening. The transaction. The company provided consulting services and received $30,000 in cash as payment. The analysis. This transaction affects two accounts. Cash. Cash is an asset. Since the company received cash, this asset increases by $30,000. Revenues. Revenues represent the earnings of the company from its operations. Providing consulting services is how this company earns money, so revenue increases by $30,000. The accounting equation. The fundamental accounting equation is assets equals liabilities plus equity. This transaction affects the equation as follows. Assets increase. Cash goes up by $30,000. Equity increases. Revenue, which is part of equity, goes up by $30,000. Why is this important? Transaction analysis helps us understand how every business activity impacts the company's financial position. By identifying the accounts affected and how they change, we can track the flow of money, see where cash is coming from and where it's going. Measure profitability, understand how much the company is earning. Maintain accurate records, ensure that the accounting equation always stays balanced. Expanded book balances. To see the full effect, you would look at the company's books, accounting records. The cash balance would be increased by $30,000, and the revenue account would also show the $30,000 increase. This keeps the accounting equation balanced. This expands on the previous example and shows how the transaction affects the overall financial position of the company. Here's a breakdown. Effects on specific accounts. Cash. The company received $30,000 in cash, increasing the cash account balance from $80,000 to $110,000. Revenue. As explained before, revenue increases by $30,000 due to the services provided. The bigger picture. Total assets. The cash increase brings the total assets of the company to $282,000. This means the company has $282,000 worth of resources it can use in its operations. Liabilities plus equity. Remember the accounting equation. Assets equals liabilities plus equity. Since assets increased by $30,000, the other side of the equation, liabilities plus equity, must also increase by $30,000 to keep things balanced. The increase in revenue contributes to this increase in equity. Expanded accounting equation and equity. The expanded accounting equation helps us understand how different components affect equity. Revenues increase equity. When a company earns revenue, it increases its ownership claim in the business. Expenses decrease equity. Expenses are the costs of doing business. They reduce the company's ownership claim. Key takeaway. This example illustrates how a single transaction ripples through the accounting system. By analyzing these effects, we get a clearer picture of the company's financial health. We can see how much cash it has, how much it's earning, and how that impacts its overall financial position.
Finally, if you like the video, please give it a thumbs up and share it with classmates or colleagues. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. It's always nice to hear from you. If you think there's something I can do better, please leave a comment below the video. So, thank you very much for watching. I wish you the best of luck in your work and studies. I look forward to seeing you again next time.